Day 19. So we're just continuing with the questions for the second chapter, asset classes and financial instruments. So let's begin with the questions from the Indian perspective. On 24th March 2009, the NSE announced that it would calculate Nifty based on free float methodology rather than full float method from 26th June 2009. Which stocks are the biggest gainers? Who are the losers? How is this shift in the index computation methodology going to change the index funds portfolios? What about the non-index funds? So let's just put that into DeepSeek. So the full float methodology is the index was calculated using the total number of shares issued by a company. This included shares held by promoters, governments, and other strategic holders that were not available for public trading. Free float methodology is basically when the index is calculated using only the shares that are readily available for trading in the market. It excludes promoter holdings, government stakes, and other strategically locked in shares. This shift means that a company's weight in the Nifty index was no longer based on its total size, but on tradable size. Who were the biggest gainers and losers? So the gainers were companies with high free float factor, a large percentage of shares available for public trading. The losers were companies with a low free float factor, a dominant promoter or government ownership. Biggest gainers weights increased. These were typically companies with diversified ownership, where promoters held a relatively small stake. Infosys, ICICI Bank, HDFC Bank, Reliance Industries to a certain extent, and other private sector banks and IT companies. These companies already had a large market cap and a high proportion of shares available for trading. The new methodology amplified their weight in the index because their tradable size was very large compared to their peers. Biggest losers got their weights decreased, as we know. So these were companies with significant promoter, founder, family, or government ownership. Public sector undertakings (PSUs) like ONGC, State Bank of India, SBI, NTPC, BHAL. The government held a majority stake in these companies, meaning the free float was a small fraction of the total market cap. Their weight in the Nifty reduced dramatically. Family promoted companies, some large industrial houses where the founding family retained a controlling stake, also saw their weights reduced. Impact on index funds. The impact on index funds was direct, mandatory, and immediate. An index fund's sole mandate is to replicate the index as closely as possible. Mandatory rebalancing. On the effective date, June 26, 2009, all Nifty index funds were forced to rebalance their portfolios to mirror the new weights. Significant selling, they had to sell large quantities of stocks whose weight in index was reduced, example ONGC SBI. This selling pressure could have temporarily depressed the prices of these stocks around the rebalancing period. Significant buying, they had to buy large quantities of stocks whose weight in the index was increased. Example, Infosys, ICICI Bank, HDFC. This created buying pressure and likely boosted the prices of these winners in the lead up to and on the effective date. The portfolio of Nifty index fund became more heavily tilted towards the high free float sectors like banking, IT, and Reliance, while its exposure to PSUs diminished significantly. So, so basically, index funds sold basically shares of like government or privately owned, largely privately owned companies, and bought more publicly traded companies. So to adjust the index so that they can accurately track it as closely as possible. Impact on non-index funds, active funds. So impact on non-index funds was more strategic and nuanced. Front running the change, astute active managers anticipated the massive forced buying and selling that index funds would have to do. They could front run the trade by buying the gainers, high free float stocks before the index funds were forced to buy, hoping to sell them at a higher price later. Wait 1 second. Buying the gainers, okay, before the index funds are forced to buy, hoping to sell them at a higher price later. Okay. Selling the losers before the index fund selling began to avoid the price decline. Okay, makes sense. Basically, getting ahead of the market so that you don't lose any money and also you make a lot of profit. Strategic decisions, overweight slash underweight positions. An active manager who was bullish on PSUs might have decided to overweight them even more after their weigh-in in the index fell, believing the forced selling had created a buying opportunity. Conversely, a manager could have decided to underweight the high flying, high free float stocks if they believed they had become overvalued due to index fund buying frenzy. Performance deviation. The rebalancing event created a significant short term dislocation. Active fund managers' performance relative to Nifty index during this period depended heavily on how they position their portfolios in relation to this one time structural shift. So that's the first question. Uh, Second question is, visit the website of the Mumbai Stock Exchange to find out the change in Sensex composition since 1st January 1986. So this will be interesting. Let's go to the website. So yeah, let's go to the BSE India. has been moved. The page has been moved. Okay. Uh, Sensex view. Okay. So this is Sensex. It's pretty complicated to read, I guess. But yeah. All time. Can't make a graph. Is this like the time? Oh. Wait a second. 1st January. 1st January 2029. We can only do that. Wait. 1 second. Okay. 1986. What? Yeah, okay. Yeah. Okay. Um, hmm. Yeah, okay, we got the graph. So from 1986, 1st January, it was at like, what's the starting point? Like 905 uh, points. And right now it's at, wait a second. What the hell happened? So part A of the question is often it's alleged that exchanges include stocks that have performed well in the past and not necessarily those that are representative of a sector. Do you agree with this view? Um, I wouldn't know whether to agree or not. What the hell, man? Okay, found the graph again. So right now, November 7th, it's showing again. It changed, but like, what the hell is happening, dog? Uh, hmm. Well, basically, it just increases. So, okay, Sensex composition. So this is just like Sensex, like in general. I don't know where the composition is. BSE Sensex, yeah. I guess we can see the sector wise. website's not loading. So yeah, let's just put the question into DeepSeek and go from there. So, do you agree with the view that exchanges include stocks that have performed well in the past? Yes, there's considerable merit to this allegation. While index committees have formal objective criteria like market capitalization, liquidity, and trading frequency, the selection process is not purely mechanical and is susceptible to a form of performance bias. Here is why this view is persuasive. Performance as a proxy for quality. A stock that has performed well in the recent past is likely to have a large and growing market cap, high trading volumes, and significant investor interest, all of which are objective criteria for inclusion. Therefore, past performance becomes a de facto, though unstated filter. The halo effect. A company with strong performance track record is perceived as a winner and a better, more stable representative of its sector, making it a psychologically safer choice for the committee. Third, avoiding controversy. Including a poorly performing or financially distressed company, even if it is large, carries reputational risk for the index. Selecting past winners is a less controversial path. In essence, while the goal is to be representative, the methodology often ends up selecting stocks that have already succeeded, potentially making the index backward looking rather than forward looking. Comparing the sectors of outgoing and incoming stocks, is there a pattern? Yes, a very clear and powerful pattern emerges when you analyze sectoral changes in major indices like the Nifty 50 over time. The pattern reflects the changing narrative of the Indian economy. The pattern. Incoming stocks typically represent the new economy or high growth sector, while the outgoing stocks often belong to the old economy or stagnant sectors. Let's break this down with a hypothetical but highly realistic example. based on recent trends. So we don't need to do that. We just need to now read. Yeah, 1 second. So those are the last parts of chapter 2. Then we just have the e-investment exercises. So we just do that as well. I don't know if I did that in the first chapter questions. Did I write it in the document? Oh yeah, I did. Okay. Okay. So copy. So now is the fun part, the e-investment exercises. So let's log on to finance.yahoo.com. Oh, again, it's R.R. Donnelly and Sons. Can we tickers? Can we search that RRD? Will that come up? It's a very slow running website. I don't know if it's the website on my laptop. Probably a bit of both, but yeah, pretty slow. A lot of content on the page. So, no, not that one. In the get quotes box. Where's the get quotes box? Hold up. Oh, there it is. Quote lookup. Let's see if we can find it. What the hell, man? Jesus Christ. I'm just getting Royal Road Minerals Limited. Oh my god, man. Why did they have to give such a niche company, man? Haven't we already done this? Yeah, we've already done this actually. What the hell? This is the same as the last one. Pretty sure. 1 second. Yeah, we've done this. Yeah, we went to FINRA, we went to IOSCO, ISCO, SEC.gov. Yeah, we've done all this actually. We might actually be done with chapter 2, surprisingly. 1 second, let me just check if I've done this before. I think I have. This is, yeah. 1 second. Yeah, okay. Shares outstanding. What? Dude, have they given the same EN investments exercise for both chapters? This is the same, bruh. Yeah, it's the same. Why have they given the same e-investments exercise? That has to be a typo or something. But hey, good for me. I don't have to do investment exercise now. So that's amazing. Just 1 second, let me delete that then. Just open. Same chapter 1. So we are done with chapter 2. That is brilliant, actually. So yeah, really happy about that. Let me just do some formatting. Yeah, okay. Now we begin with chapter 3 tomorrow. Yeah. Okay. Okay. No, we don't need notes. I don't think we do. But I don't know why I've uploaded these pages here. I don't need these pages anymore. Yeah, I used to have them here, but I don't really need them anymore. I did for a 4th chapter also. 5th also. That's crazy. Okay. I mean, I don't have a problem, but yeah, so till chapter 5 the document is like that. So then after that I'll change it, or I won't change it. I'll just stop taking the picture and uploading it like that. So yeah, we're done with chapter 2, asset classes and financial instruments. It was a good chapter, great chapter. We learned a few formulas as well, comparing municipal bonds to taxable bonds, figuring out what the cutoff tax rate is to be indifferent between both bonds. We found out what strike price, what exercise price, option difference between options and futures. If you would, when would you want to exercise, or when would you want to exercise your call or your put, and stuff like that. How much profit would you make on a commodities future transaction? What else? Yeah, pretty much it. Yeah, bid price, ask price. Yeah, that was something. What else? Preferred shares, preferred stock, common stock, dividends, tax benefits of having dividends, stuff like that. Indexes, market value weighted, price weighted, a lot of like different methods or methodologies of finding indexes, full float, free float. So yeah, pretty good chapter. We'll start with chapter 3, how securities are traded, tomorrow. Thanks.